Hi, this is Professor Karen Lin. Welcome to the Financial Accounting course for undergraduate students. Starting from today, we are going to start Chapter 2, Accounting Process. Let's get started. In Chapter 1, we learn about the accounting system and the 4 financial statements, as well as answering the question, why do we need accounting? Now, starting from Chapter 2, we are going to get into more technical details. For example, how do we prepare financial statements? How do we do debit and credits? So on and so forth. So in this chapter, you're going to learn the qualitative characteristics of accounting information, the transaction analysis, which means how business transactions would affect accounting equations and a firm's financial status. We're going to learn how to do debit and credits, what are the normal balances of accounts. We're going to learn T accounts and trial balance as basic tools. Now in this chapter, these are the basics or fundamentals of accounting techniques that you will need as accounting students or as a business students. Let's start with the balance sheet and accounting elements. In the next chapter, we'll talk about the elements of income statement. There are assumptions underlying balance sheets. The first assumption is called separate entity assumption, which means when we prepare a balance sheet, we assume the balance sheet reports as a separate entity. Formally, each business activities must be accounted for separately from the personal activities of the owners, all other persons, and other entities. When you look at a balance sheet, you know it's a snapshot of the financial status of one entity. The second assumption is going concern. Going concern assumes that the business will continue operating into the foreseeable future, long enough to meet its contractual commitments and plans. What does that mean? That means we assume our company could last forever. I know this is not a very realistic assumption, but using this assumption helps us to maintain the operation of the balance sheet and the continuity of the balance sheet. The third assumption is the monetary unit assumption. This assumption assumes that the financial statements are reported using the national monetary units, which means dollars in the United States, Japanese yen in Japan, so on and so forth. So to summarize, if you look at a balance sheet, you know this balance sheet is measuring the financial status of one company, not the company's owners or the related companies and so on. It's about the company. And we also assume the company going forever because that keeps the continuity of the balance sheet across different periods. If we know tomorrow is the end of the world, you probably won't want to prepare a balance sheet, right? So assuming continuity is one of the key assumptions underlying the financial statements. Finally, you need to use the monetary unit that's prevailing in your country. Now, underlying the balance sheet, there is something called measurement concept. In accounting, historical cost is one of the important measurement concepts, which means in the balance sheet, all our elements are initially recorded at their cost. For example, if we purchase inventory, now let's assume we are a bookstore. We purchase some books, right, to sell to our customers. Now, these books, when we purchase the books, we record the cost of the books in the purchasing or the invoice price, plus any transportation of the book, right? If there's any insurance, any lawyer fees, whatever fees related to the book, you want to record it. So that's what we call historical cost, which means when we record something, it relates to the original cost to acquire the resource. As we introduced in Chapter 1, the elements of a balance sheet includes the assets, liabilities, and stockholders' equity. If you would remember, assets always equals to liability plus stockholders' equity because assets are the resources that the company needs to run its business. Liabilities and stockholders' equity are how the company funds itself. Let's start with assets. What are assets? These are the features of assets. Assets are 1. Economic resources, 2. Owned or controlled by a company, 3. They have measurable value, and 4. They're expected to benefit the company in the future. Now, I listed a couple items underneath. Before I talk about those, you can pause the video and think about whether these are assets of the company based on the features I talked about above. All right, the first item, a computer owned by the company. Is this an asset? The answer is yes, because 1, it's an economic resource that the company needs to run its business. 2, it's owned by the company. It has measurable value. Remember historical cost? You acquire the computer with some cost. Finally, it would be expected to benefit the company in the future because the company is going to use the computer in the operation and generate profits from it. So a computer owned by the company is an asset. Second, a car owned by the CEO of the company. Now you can see a car is an economic resource. A car has measurable value, and a car expected to benefit the company in the future. However, this car is not owned by the company, so it's not an asset of the company. Now this may connect dots with you when we talk about separate entity assumptions a few slides before. So a car owned by the CEO of the company is not a car owned by the company, so under the separate entity assumption, this is not an asset for the company, but an asset for the CEO. All right, third, Apple's logo. Now this is a tricky one. Apple's logo sounds like an economic resource. It's owned or controlled by Apple. It is expected to benefit Apple in the future because Apple's logo is valuable and consumers recognize it. The only tricky part is Apple's logo is not measurable. So we cannot reasonably measure how much Apple's logo is worth. When that happened, it's not an asset for Apple, or it cannot be recognized as an asset for Apple. Now this is a more subtle and complicated example. You don't need to master it, but keep in mind there are some things that we cannot measure and thus they are not assets. The last example, the moon or the air. Now those are resources and we all need it. If there's no air, our employees will all die, right? So we won't have it. So it's necessary for us to run not only the company but also the whole society. However, the moon is not owned or controlled by the company. The moon has no measurable value, although it is an economic resource and expected to benefit the company in the future. All right. So among all these examples, only number 1, a computer owned by the company, is an asset for the company. As we discussed before, assets are listed on the balance sheet in terms of liquidity. In addition, assets are grouped as current or long-term assets. Now, these are also based on their liquidity. Current assets are resources that the company will use or turn into cash within a year. For example, cash, short-term investment, accounts receivable, and so on. Long-term assets, on the other hand, cannot be used or turned into cash within a year. So it's longer than a year. For example, if you have a building usually lasts for more than 10 years, so it's not a current asset, it's a long-term asset. All right, liabilities are the second element on the balance sheet. Now, liabilities are easier to understand. Those are obligations resulting from a past transaction, and they are expected to be settled in the future by transferring assets or providing service. For example, if our company borrow a loan from a bank, we are expected to pay off the bank in the future or provide some service in exchange of cash and then pay off the bank. So liabilities are obligations. Again, liabilities are listed in order of maturity, and they are also classified into current liability, which means they need to be paid back within a year, or long-term liability or non-current liability, which are going to be paid back longer than a year. An example of current liability would be accounts payable or accrued expenses. We'll talk about those items in the future. Long-term liabilities include notes payable and long-term lease liabilities, and so on. Alright, finally, stockholders' equity. Now, the textbook mentioned that stockholders' equity represents the residual interest in the assets of entity after subtracting liabilities. What does that mean? Residual interest means the shareholder owns whatever left over after the company pay back the creditors. For example, a company went bankruptcy. When that happens, the company will sell all its assets and turn those, for example, into cash. Those cash has to be paid back the creditors first, and the rest will go to the shareholder. Now you can see that's why it says residual interest, because whatever left will go to the shareholder. From another perspective, if a company earns huge amount of money, now the creditors only own a small portion of it, and it's a fixed portion because interests are usually fixed, say 3% per year, right? 10% per year. Those are fixed amount. Anything left over, residual, goes to the stockholders. So that's the idea of stockholders' equity. Stockholders' equity basically represents the claims by the shareholder, and it's the residual interest from the assets. When we talk about shareholders' equity, we talk about how the company obtain resources from the shareholders is by issuing stocks, right? We sell the stocks to the shareholders and then we obtain cash from them. Now, that is called contributed capital, which is at the beginning of the company's operation. So when the company first starts, it borrows from the bank and then it also sells the stock to the shareholders. Now, once this company starts to run, the company makes profit, most likely. When the company makes profits, we talk about in the first chapter, those profits will be kept in the firm after dividends. Now, when it accumulates in the firm in the form of retained earnings, right? Retained earnings means net income kept in the firm. So those are called earned capital. Now, earned capital are basically coming from the performance of the firm or the profits of the firm. All right, to summarize, a company's financial statement balance sheet has three elements: assets, liability, and stockholders' equity. Assets represents the economic resources the company owns or control, which has future benefits to the company, and also measurable. The company's assets are funded by borrowing from the creditors, liabilities. And liabilities are usually have a fixed return, which is called interest. The rest goes to stockholders' equity, or stockholders' claims. Now, stockholders has two parts in their claims. One is their contributed capital, which they pay to purchase the shares at the beginning of the company's operation. Once the company starting operating, the shareholders get the profits accumulated in the company, which represents in retained earnings. All right. So this is the idea of balance sheet and its element. In the next video, I'm going to start introducing some basic techniques of accounting. I'll see you in the next video.